If you're like millions of Americans and home values that continue to rise, you now have equity in the house. Today, we're going to be looking at the pros and cons of taking equity out of your house with a home equity loan or a home equity line of credit. We're going to compare both of those, kind of break down the reasons or the logic why you would want to, a lot of times when you do not want to. Now, when it comes to debt, it seems to continue to rise, whether it is credit card debt, whether it is lending debt, borrowing, unsecured loan. A lot of people are looking to consolidate right now, and they are looking to home equity. So what a home equity is actually using the equity that is built within your home, meaning that as you continue to make payments to your house, you are making a portion of that payment to principal, which is lowering the balance of the house. Well, in conjunction, as home values continue to increase, now you have an equity position in the home itself, meaning that you can take money out of a home equity. Now, with that being said, that is leveraging money in your home. Now, it can be used for different purposes. A lot of people do use them for education costs. We see them for home improvements because for a majority of people, this is the biggest source of funds that they're going to have, where if you have $50, $70, $100,000 in home equity, you can actually take that home equity out for borrowing needs, and it's at a much lower rate because the home is the collateral for the product. So let's get into the pros first, guys, of doing a home equity loan. And I also do want to compare the home equity loans versus the line of credits, which a lot of people do rely on in this kind of crazy rate environment that we're seeing right now. So some of the pros for a home equity: it is a stable and it is a predictable interest rate. With a traditional home equity loan, it is a fixed rate, it is a fixed term. The thing with the home equity is not only being able to borrow more money, is having the ability to actually have that fixed rate, that fixed term for a longer term. Some home equities go for 5 years, 10 years, even 15 years in a repayment phase, which is very similar to what we see with the mortgage products, where you can take it for an extended amount of time. Pro number 2, you get a consistent monthly payment. So you know exactly if you're taking out for 5, 10, 15 years, you know exactly how much interest you're paying regardless of rates going up and down. You also know exactly what your monthly obligation is going to be because, of course, this is tied to the home in the case of the home equity. So you want to make sure that you're making those payments on time. Now, the other big perk of this, guys, is lower interest compared to other loan options. Home equity, because they are collateralized, because they actually have something tied to it, usually run 3, 5, if not higher percentage lower than what we actually see with traditional credit cards that we see with personal loans, where home equities might be at 7, 8, 9%. The personal loans usually run about 13% plus. Credit cards can run 20% plus, which is the reason why home equities are a primary source of debt consolidation. So if you're an individual sitting out there with $30,000 in credit card debt at 25%, you can consolidate that $30,000 over 10 years at 7%. You are going to be saving tens of thousands of dollars of interest just based on the balances over the term. Now, of course, you have to be really careful about this, guys. Some of the other advantages as we continue the pros, there is the repayment period. It can actually go up to 30 years on home equities. So when you think again of traditional mortgages, doing the 10, the 20, and the 30, or doing a 15 and 25, any combination of them, there are some lenders to really make the payment affordable that they will do home equities up to 30 years, which is a great extended time if you're looking for the tax payments. Now, in addition, guys, there is a tax advantage depending on your situation. If you use a majority of the money for significant improvements or repairs to the property that is securing the loan, this can actually be a tax deduction if you itemize the returns. Now, since the tax laws have changed, definitely talk to your tax advisor because most people are not doing the itemized deduction. However, if you're putting significant home improvements in there, it actually make more sense for you to go ahead and itemize the deductions because of how high the bills are with the home equities. And again, if you're borrowing $150,000 using it for home improvement, that is a big tax advantage that you could possibly have, superseding what you get from just the standardized deductions. However, remember, guys, there are cons to a home equity. Number 1 being the biggest and the most expensive, the prospect of losing your house. Since you are putting this house up as collateral for the home equity product, if you are not making the payments, they could foreclose on your home based on the not being paid. Even if you're paying your primary mortgage, you could be foreclosed on the secondary mortgage or the home equity line based on not paying of that one. Another big con is the risk of the negative equity. If you guys were around for 2007, 2008, where we seen a 40 to 50% decline in the prices, the property's worth. If you have a home that you have a 50% LTV, you all of a sudden take a home equity and then you're at 80% loan to value, or you're at 80% of the equity utilized within your home. If there is a significant decline in the market, you could actually be what they refer to as underwater, meaning essentially you owe at a balance that is much higher than what the property is worth. So if you were forced to sell it in this situation, you would be taking a loss and the creditors would be coming after you for the money. Now, in addition, guys, there are higher lender criteria. Qualifying for home loans typically have a minimum of 15% of ownership, which I know there are 80% home equities, 90% home equities, and there are a few institutions that do 100% of the value home equity. And it is also going to be based, of course, on credit score. So if you do have damaged or poor credit, chances are you're going to get a higher rate when it comes to the home equity process. Now, in addition, guys, the application process takes a lot more time. The underwriting guidelines for a majority of financial institutions are the same as a mortgage as it is for a home equity, because in both cases, you are using the equity that is in your house and you are using the similar loan of what they're securing it in the methodology that they have for securing that loan. Then, of course, guys, you have to be super careful about upfront fees and closing cost fees. Most of them come with origination fees, appraisal fees, various administrative fees, closing fees. If you close it early, annual fees. You have to disclose and you have to know about this all up front before you actually get into it. Now, do all home equities have fees associated with them? Absolutely not, guys. There are a lot of lenders, including credit unions, that cover the fees internally. No origination fee. Most of them do not have an appraisal fee, only under strict circumstances, depending on the property. Title fees and processing are usually waived as well. Now, we get into the home equity loans versus the home equity line of credits or the HELOCs. Now, the big thing right now, guys, is if we're in a low rate environment like we've seen again going into 2000 when they went to almost literally zero, home equity line of credits or HELOCs are very, very affordable when it comes to the payment, but the home equities are fixed rate, fixed term. The home equity line of credits or the interest only line of credits are variable rate. That is the big difference, guys. So I'll just put it in perspective. We had home equity loans at the credit union. They were running about 4.5%, 5%. Pretty good rate if you were fixing it in for 10, 15 years. Definitely a solid plan. Home equity line of credits on the same manner were about 3.5%. So definitely saving some money over there. If you did a 10-year home equity line of credit at, let's say, that 3.5%, much easier on the payment because it is not the set rate, set term that we're seeing with the home equity line. But now you fast forward, guys, where home equity line of credits are roughly 9%. The person over here that was still with the fixed rate, fixed term is at a much lower rate than what we're seeing the home equities. And that continues to be the truth and be what we're seeing again without having the locked in interest rate. We have a lot of people who are going from those HELOCs and those interest only HELOC products that are moving it to fixed rate, fixed term, even though it might be a little bit higher in comparison right now because we're in a high rate environment. It is actually much more effective and efficient to do the home equity fixed rates versus having the open line that can vary. Now, of course, guys, again, the big thing with the HELOCs is the variable rate that can be super, super difficult to deal with. Do you need a mortgage to get a home equity? Nope. You can have a first lien or you can have a second lien position. For instance, if your home is free and clear, you can actually get a home equity in a first lien position. And because the financial institution is in that first lien position, it is going to be a much lower rate than them taking the second loan position. And what that means essentially is if the house is foreclosed on, the bank or the primary first lien institution gets paid first. If there's anything left at that point, the rest of it goes to pay off that second lien, which is the reason why they give you a different rate for both of those. All right, guys, so that'll do it for today's video. I really hope I helped explaining somewhat of a home equity, some of the scenarios that we see and the difference between the home equity loan and the HELOC. Definitely consider subscribing to the channel, guys, if it's really helping you. Let me know in the comments what you guys think, and as always, thank you guys for watching.